Welcome to Morning Brief, presented by Robinhood, the home to commission-free trading. I'm Julie Hyman. Here's what we're watching today. First up, stocks look to close out a week of gains. We'll dig into the driving factors and why Wall Street sees more gains ahead. Plus, Nike shares drop as the retailer's outlook disappoints. We'll break down the results and the hurdles facing the business. And Oracle shares jump as TikTok parent ByteDance formally signs the deal to create a joint U.S. venture for the company led by the cloud services provider. Let's get a check-in on stock futures on this Friday. This is the last full trading week of the year, folks. After this, we got a couple of holiday-shortened weeks. And so given that, we're not seeing much action in futures here this morning. Nasdaq futures pointing to a gain of about 0.5%, but we're seeing very little change in the Dow and the S&P 500 futures. A little bit of a breather here after we had some delayed economic reports this week, but we still had some interesting earnings reports, including from Micron. Let's take a step back now and look at one of the best performing groups this year, actually, maybe surprisingly. It's not AI, it's not tech. I'm talking about America's biggest banks. They're actually ending 2025 on a high note with record stock prices, growing balance sheets, and more regulatory freedom. So let's talk more about this now. Joining me is banking reporter David Hollerith and Kevin Mahn, Hennion and Walsh CIO. And I know, Dave, you've been sort of digging into the year that was for big banks, but I think what's kind of surprising, first of all, that we should just kind of call out is that if you look at that KBW banking index, which tracks the banks, it was up 28% or so this year.
Yeah.
So definitely outperforming.
Yeah, so that happened last year too. Not to the same degree, but it outperformed the S&P 500. And the thinking among a lot of analysts is that it could do so again next year. So that really comes down to the growth plans that a lot of the biggest banks are laying out. And then the backdrop here is that there's this wider deregulation of financial services that the Trump administration has been pushing, and that is giving them a lot more freedom. So as far as this year goes, the biggest banks have really benefited from their Wall Street operations. Trading and deal making have both been pretty phenomenal this year, and that's pretty unique. And then as far as looking to next year, a lot of these banks are making pretty big growth plans.
Yeah, exactly. And so all of this combining for the performance we've seen, and those trends are probably going to continue. I mean, what's interesting is we also have a decreasing rate environment, which you think wouldn't necessarily be good for the banks, but we also had the yield curve uninverting. So if you're a bank and you're borrowing down at one rate, you want the bank at which the rate at which you're lending out to be higher than the rate at which you're borrowing. And for a little while, it wasn't. And then we saw the yield curve uninvert. And so as long as it stays that way, I guess for next year, that will be positive for the banks that get a lot of their net interest income, that's a big source of their business.
Yeah, as far as interest rates goes, there's a lot of different factors playing in. Also just repricing of their huge securities portfolios. But as far as growth goes, again, it means to a certain degree that as rates come lower on the short end, they also need to look out into other kinds of assets to find the same kind of growth they've had for the last couple of years. That's sort of where lending comes in, which is kind of like the pure play thing that is hoped for, is that there would be more opportunity for banks to lend next year, and that's very weather permitting, whether or not that happens, but that's the hope at least.
Right, that the economy grows enough for them to do that kind of lending, and if you talk to economists, they're sort of split to some extent on that. So that's interesting. And then the other part of it is combinations, consolidation, which we already started to see this year. This is a trend, Kevin, I know that you're watching closely. I mean, we already saw a bunch of regional bank mergers announced this year. How do those mergers tend to work out in the banking business? I know we've been talking a lot lately about like Paramount and WBD. Media mergers don't always work out so well for the shareholders.
Yes.
What about financial mergers?
So I agree with Dave. I'm optimistic on the outlook for the financial sector in 2026, but I see more growth opportunities for the smaller cap regional banks than I do for the large money center banks. Improving net interest margins, we have lower interest rates, we have treasury prices going up. Remember, they hold a lot of treasuries on their balance sheet, less regulation, and the prospects for more M&A activity. And I think about a company in New Jersey. Let's take a New Jersey community regional bank, Provident Financial Services, ticker symbol PFS, trading trading at about 10 times current earnings, dividend yield of 4.5%. They're diversified with a wealth management business through Beacon. They have insurance, and they have traditional banking services. You can't tell me that a large cap money center bank with free cash flow on their balance sheet isn't going to at least consider acquiring a company such as Provident in the new year.
Okay, so if you're betting on an acquisition, fine, but aren't the smaller banks more vulnerable to the economic weather? I like the way that you put that, Dave. The weather, right? Because their business is more pure lending. So aren't they more dependent on economic growth?
Absolutely, and given that I'm still soaked from walking in today with all the rain outside today, they have to be weatherproof. And I think the way you weatherproof the regional bank portfolio is to build a multi-name portfolio. So we have a trust called Premier Banking Opportunities, invest in 30 different regional banks. And I think you have to look to those regional banks that don't just offer traditional banking services, that are leaning into fintech, that do have a wealth management component and also offer insurance services. That type of diversified base can offer you all-weather protection.
I mean, I imagine the other thing that should be helping next year, Dave, is not so much for the small regional banks, but for the bigger, more diversified banks is like there's expected to be more IPOs next year, for example. So the sort of capital markets business, in theory, should also do well.
Yeah, deal making is a little bit like the weather too, in terms of the constant green shoots. But just if we look at the IPO market, there's a lot going on around the U.S. government shutdown, where some larger companies kind of push their plans back, and so a lot of that is we're going into 2026 with the expectation that there will be maybe more IPOs as a result. There's also a couple big names that have been talked about, and if companies like SpaceX or something like the government-sponsored home lending entities
Freddie,
go public next year, those will be huge.
Sure.
And so that is definitely something that Wall Street's sort of watching with a watered mouth, I guess.
Yeah, definitely. I mean, are you looking at some of those IPOs for next year? Like, I don't know how you guys think about IPOs in general.
I mean, we're really encouraged about the prospects for more IPO activity, for share buybacks, for M&A. All of that's good for the stock market in general. And since we just passed the 3-year anniversary of this current bull market runs, all three of those areas are potential tailwinds to continue that into its 4th year. So yes, we look at that. We don't invest in the IPOs directly, but we're very interested in the benefactors sitting around those IPOs.
Gotcha. Okay, guys, I have to ask a question.
Yep.
That I think we have to ask about everything right now, unfortunately, when it comes to any industry. What's the AI play when it comes to financials? Sorry, but this is, you kind of have to ask it. And I have had more investors saying to me recently that yes, they're looking at the NVIDIAs, et cetera, of the world, but they're also looking at companies that are going to be incorporating AI.
Oh, yeah.
How is that going to be helping their businesses? When are we going to start to see that flow to the bottom line? I mean, I know banks are talking about AI, Dave.
Yeah, the biggest banks are definitely on this, at least in terms of what they're telling investors. And a lot of it, Bank of America kind of explained it this way, which is that they said, to a certain effect, the amount of call center operators they had to hire in the last couple of years is down by, I can't remember the exact number, but it was in the thousands. And so they see efficiency gains. And that's actually a big story for the biggest banks, is that they're all looking to get more efficient, except for JP Morgan, which is, always looking to get more efficient, but they're kind of like at the line of where they can do it. But Bank of America, Wells Fargo, Citigroup, they're all sort of working towards that goal. And a big part of that is AI. And then obviously in the deals market, a lot of the deals market this year has been AI related.
Right, yeah, great point. I mean, when you're looking at companies that you want to invest in right now, are you trying to pay attention to what they're doing on that front?
100%. I think the bigger risk in the AI revolution is those companies who underspend or don't spend at all, as opposed to those who potentially overspend. And the banking industry is ripe for technological innovation. And I'm not just talking about fintech. How about bots in the customer service end of the world? How about using AI to actually search through your loan book to see which loans are good, which loans are bad, which loans you could consider? AI can make them more efficient and more profitable.
I mean, what do you guys think? Is this the year where, banks aren't going to hire as many junior analysts, for example, because the people who are there are leveraging AI? I know this is something a lot of folks are worried about. I don't know. Are you guys hiring fewer people on your financial
Yeah, I
company?
mean, we're at risk too, right?
Yeah.
But I think right now it's only making us better at what we do. We can now ingest and analyze large amounts of historical data in nanoseconds that used to take us hours, weeks, months to analyze. But we
So
still have the same team analyzing the data.
What are you doing with all that extra time?
Now we launch
on your
new
hands?
products, we go into new areas, so we are able to grow out our business and become more scalable using AI effectively. But over time, certain jobs could certainly be lost to AI.
Yeah, on balance, what are the banks saying about that part of it?
Well, I've heard it two ways. One is that you have to train junior analysts so they can one day be,
Senior analyst.
Senior analyst, yeah. But then at the same time, there's a big need to slow down hiring, just in the context of not having to do layoffs in the future.
Got it.
So that's what a lot of CFOs I've spoken to are thinking about. But there's no telling, at least from my perspective, how this will play out with the labor market over the next couple of months.
Yeah, it's very difficult to predict for almost everyone.
Yeah.
Thanks a lot, Dave. Appreciate it. Thank you. And Kevin's going to stick around with me because coming up next, we're going to bring you today's top trending tickers and give you some of Kevin's strategy tips for the new year. We'll be right back. Welcome back to Morning Brief presented by Robinhood. Now time for some of today's trending tickers. We are watching Oracle, Nike, and FedEx. First up, Oracle. Shares gaining after TikTok parent ByteDance announced it signed a deal for the U.S. joint venture, long awaited. The new U.S. operations of TikTok will be managed by Oracle, Silver Lake, and MGX, and ByteDance will hold a 20% stake in that business. Remember, President Trump signed an executive order sealing that TikTok deal in September, though details on the transaction were scarce at the time. The deal is still awaiting approval from Chinese regulators. Next up, Nike. Shares on pace for their biggest decline since April. The apparel company warned that sales are likely to decline for the current quarter as its turnaround lags. Nike's facing persistent weakness in China and at its Converse brand. The world's largest sportswear company expects revenue to be down in the low single digits after 2 straight periods of growth. And stay tuned, we will have much more on Nike over the next hour. And finally, FedEx. The shipping giant reported quarterly earnings that topped Wall Street estimates. FedEx also raised the low end of its profit outlook for the year. The results signal the new CEO's push to combine FedEx's ground and air freight networks and slash billions of dollars in costs is beginning to pay off. Well, many on Wall Street are bullish on the year ahead, but when there could be volatility before realizing those gains. Kevin Mahn's back with us. He says the best strategy to capitalize on that market trend is simple: follow the money. It's not that simple because you got to figure out where the money is going.
Absolutely.
But I like that summary of it. I want to dive straight into some of the themes that you're looking at for this year because that's really what people are looking for right now. And I know that there are places that you're looking that are related to AI.
Yes.
But like many people, you're trying to look outside the giants that have performed well from this so far, and you're looking at AI infrastructure.
Yes.
With the build out continuing, but how do you play that now?
So if the godfather of AI, NVIDIA's CEO Jensen Huang, is correct, and his forecast for a $3 to $4 billion spend. I'm sorry, $3 to $4 trillion spend by the end of this decade on AI infrastructure.
Maybe.
Yeah, we're already at $700 billion, but we still have so much more to go. Who's going to benefit from all that infrastructure spending? It's going to be the data center construction companies, whether it's a company like AECOM or EMCOR. It's going to be the electrical connectivity companies. It's going to be the cooling solutions companies, and it's going to be the power solutions company. So I think about a company within that realm, such as Comfort Systems, ticker symbol FIX. Their stock's up over 100% year to date.
Well, let me stop you right there.
Yes.
Because how much of all that is priced in? Like, everybody knows this stuff is getting built.
Yes.
Everyone knows who the vendors are. The stock is up 100%.
Yep.
So what's not priced in yet to something like that?
All their backlog of demand, the additional data centers that are going to be constructed, and the need for cooling solutions for those new data centers.
Got it.
I mean, FIX is only trading at a forward P of around 34 right now. It's relatively reasonable for this space, right? But if you don't want to lean into the industrial sector, how about the utility sector?
Yeah, power solutions part of this as well. I mean, that's really been, and that's something that Jensen himself has talked about, that the bottleneck, if there is one, or the limiting factor on all of this, part of that could be power.
Without a doubt. The AI revolution comes to a complete halt without power. And if we're going to rely upon our country's antiquated power grid, it's only going to slow further. So these large cap technology companies aren't going to wait for our government to fix the power grid. They're going to work with the utility companies. They're going to work with these small modular reactor companies to supply them with the power that their data centers needs. And if you want to stay in the utility sector, which I'm very bullish about, how about a company like Duke Energy? Duke Energy,
one of the big legacy
everyone knows Duke,
utility
right?
providers.
Yes. They're trading at about 17-time forward earnings, not bad. They got a dividend yield of about 3.7%, not bad. But they also own and operate 6 nuclear power plants in North Carolina and South Carolina, supplying about half the electricity through nuclear fusion to Carolina residents.
Yeah, fission.
That's the future.
Fission, sorry.
Correct.
Quick slight
One letter
there.
could make a big difference.
Yes,
fusion
it can.
and fission.
Well, and on that front, you buying any Trump media on their quest to push into nuclear fusion?
I don't own any Trump media.
Okay. Let's talk about defense and security for a minute too. Why is that going to be a big theme next year?
So as we understand it, more and more money is going to be spent on defense and security solutions across the globe. NATO countries have committed to spend up to 5% of their respective GDP on defense by 2035. We just saw President Trump earmark $901 billion here in the U.S. to replenish, upgrade, and modernize our defense capabilities. So I look to all the potential benefactors of all that spending, whether it's a large cap defense company such as L3Harris, for their missile systems, their unmanned aircraft, and also they actually maintain the FAA's infrastructure around communications in our country. More and more money is going to go there as well. But then you look at some of the smaller cap plays in defense. How about Kratos Defense? The drone manufacturer, right? You're going to see more and more money going into drone manufacturing as well. So we see that trend continuing if you follow the money and all the money that's being spent on defense.
Yeah, definitely. We've seen that trend already. And then this next one is kind of interesting. Small cap biotech.
Yep.
Now, biotech is so interesting to me because I look on our Yahoo Finance trending tickers page, and there are frequently these tiny little biotechs.
Yes.
Now, sometimes they don't have any news and they go crazy. That happens with small caps.
Yes.
That, they hit on a Reddit message board or whatever
Right.
happens. But small cap biotech sometimes feels a little bit like a lottery ticket.
Yep.
Because you're betting on their experimental, whatever it is,
Correct.
working, and then a big company swooping in and buying it. So how do you game out which ones
Yes.
are a better lottery ticket than others?
So the way that we approach that through our healthcare innovation strategy, and it's our best performing strategy of the year, is we look to those companies that have at least one drug in FDA level 2 or FDA level 3 approval status, because our research shows that the majority of the takeovers take place when a drug is in FDA level 3 approval status, right before they get the final approval and demand an even higher premium.
Okay, so you're not buying the earliest stage,
No.
and once it gets to level 3, that's usually, it's not supersede experimental stage.
That's right, and that's when large cap pharma has the most interest. But I also want to find those companies that have a catalyst event over the next 2 years. A catalyst event could be a drug trial. Now, those drug trials could be positive, making the stock go up. They could be negative, forcing the stock to go down. But we build a portfolio of 30 different of these opportunities so we can help smooth out the ride. I think about a company in our portfolio called Indivior, ticker symbol INDV. They are building drug pipeline for treatment abuse. So they have 2 drugs right now in the FDA approval pipeline for opioid treatment. Boy, does our country need that right now. And once they get closer and closer to the finish line, you can't tell me there's a large cap pharmaceutical company with cash sitting on the sidelines looking to acquire that and add that into their distribution.
I mean, the thing is with some of this stuff, isn't the risk though sort of binary? In other words, even drugs that get to that level of
Yes.
development, sometimes you have a problem, they fail, or for whatever reason, a company doesn't come in and buy them.
Yes.
So this is people should think about it as a higher risk,
Absolutely.
maybe higher reward kind of strategy.
It's going to be a more volatile area to invest in, and that's why you want to smooth that out with a diversified portfolio. We use 30 names to do that. But I think the opportunity comes not necessarily just from all the tailwinds for biotech, but the headwinds facing large cap pharma, the acquirers. We know that Washington continues to push on them to lower drug prices, which compresses their profit margin. And the last stat I saw, there's about 200 drugs due to come off patent in the upcoming years, with an associated $300 billion of revenue that are now going to be subject to generic competition. How is large cap pharma going to replace all that lost revenue? They can't turn to their own pipeline, so they're going to have to be acquisitive. So that's where I see the opportunity.
That's interesting. So not only do you like those small cap biotechs, you probably like them at the expense of, or very much instead of, the large cap.
That's exactly right.
Pharmaceutical stocks. It's also really interesting to hear you say that strategy did the best this year.
Isn't that amazing?
How much was it up overall?
Over 60% year to date.
So that's so interesting because shame on us maybe a little bit. We talk so much about AI this year. The biggest stocks, that's where the gains have been in many cases. But here's a small thing that's not an AI strategy.
Biotech, aerospace, and defense are going neck and neck with AI and AI infrastructure, even power solutions. They're all 30% plus up year to date, but biotech is leaps and bounds ahead right now. And if that pace of M&A activity continues into 2026, you might want to consider adding some allocation to that area.
Interesting. Kevin, thanks so much.
My pleasure.
Fun time today. Appreciate
Absolutely.
it. Coming up on Yahoo Finance is more of a fun time. Opening bid with executive editor Brian Sazzi. Saz, you've got some surprises up your sleeve today. I'm excited.
Julie, I have nothing to say on biotechs, but I very much enjoyed your conversation. I think that was absolutely mind-blowing. But I'm going to go off on Nike. Didn't like this quarter. Didn't like the earnings call. I don't know what Wall Street is seeing with all these positive notes that I've got in my inbox this morning. It makes no sense to me. We're coming out blasting, Julie.
Uh-oh, Sazzi on the warpath. Buckle up, everybody. All right, that does it for Morning Brief presented by Robinhood. Opening bid is next.